Now, if you're serious about building long-term wealth, you may have asked this question before. Should you buy individual dividend stock or just buy an ETF and chill? Now, I do both, and the truth is, I think there's a gap for both, and I think you should do both, but I think it depends on your risk profile, your age, and how involved you want to be. So in today's video, we're going to outline both of them in simple terms and what could work for you, and also an action plan that I do that may work for you. And I'm also going to showcase how to buy them, just so you know, and what the difference is when you press that buy and execute button on Trading 212, for example, or your broker. Now, I want to explain in simple terms, without blowing your bollocks, how to buy and what to do and why dividend stocks work in the way they do. Now, firstly, I need to explain that companies, real tangible things, for example, will have profit share, and that is done via dividends, right? Now, the big caveat to all of this is it will go on performance of the company. You need to buy quality companies, not the companies that are hype or speculative, the solid ones that you know and love and you see every single day. So, for example, with my ones, I have some very obvious ones. For example, Drax, Aviva, Admiral. I have National Grid, Tesco, even Mighty, and even Coca-Cola, HBC are very obvious ones. That's a bottling company for the biggest brand pretty much in terms of drink beverages these days. So they're not like, oh, what are they? So that is the thing I think a lot of people fall down on. But going on to my portfolio here on Stockopedia, which is a fantastic tool, by the way, if you want to do some deep research. If I go onto the likes of, say, Mighty, for example, right? Let me just showcase the report. It'll tell you roughly the performance of the company, which is good. But when you get dividends, right, it's all based off what is in the profitability of the sheet in terms of down here. What are they going to pay? How much has it grown? And all that kind of good stuff. But also, when do they get paid? So on here, you can see very, very clearly when do you get paid, and why should you get paid is because they have profit in their company for obvious reasons. Now, they then share it to their shareholders, which is good. Now, I will talk about my strategy in a minute, but the biggest thing to look for with any dividend company is it a rising dividend. What is the dividend yield? Is it too high or is it too low? And why are people buying it? Because one of the hidden characteristics about dividend stocks is the best ones are the ones that grow their dividend year after year, most of the time, because they're a really good company. Now, with my sort of strategy, and I think this is important to know if you're wondering, I go for quality, value, growth, and momentum as a rank on Stockopedia. These are like companies that are doing a lot. The reason being, and why this is important, is you want a company that's healthy. And that's the fundamentals crux of anything. High quality, profitable companies will give you a consistent and a constant flow in the dividend cargo. Let me explain that bit. So for example, with Tesco, right? It's looking pretty good price-wise. Everything's looking hunky-dory. And the thing is, down here, you have a DBS growth cargo, which is the dividend per share annual growth rate. What is it doing? That is at nearly 8%, which is pretty damn good. So that is telling you that there's a compound effect that is growing their dividend. And you can see here over the course of time. So if I go in here, now obviously minus the fact of COVID and how it went a bit mental, you can see that the dividend is actually growing on average every single year. That's important. Now, you can't see it amazingly because it's not the best chart in the world because of this special interim one, but you get the idea, because when you go back and you look at the overall dividend itself on the sheet, you can see it is growing. Big, massive growth all the way across the board. And you can see over the course of time, it is growing. That is why most stocks in the dividend world don't have hype. They don't go in cyclical mental craziness. They hold pretty steady. And a lot of people, I think, see that as a negative. But for me, it's all about the income. Because what happens with the income, as that yield changes and grows, your yield on cost will change as you reinvest a dividend. So if you're getting a dividend and you're reinvesting it back into the company, you've got to start noticing this increase. Therefore, in 5 to 10 years' time, that's going to be much higher. You're going to be making a lot more money on the stocks that you bought a lot earlier, realistically. And this becomes apparent when, and this is when, you fill up your ISA allocation. Because if you can put, for example, here, the maximum in a stocks and shares ISA, for example, 20 grand, and you get, say, 3, 4, 5 grand back in dividends, you can reinvest that alongside what you've already put in. So you can beat the system with income, which is important. You can do the same with profit, by the way. But at the end of the day, it is cash flow. And that is why we need to talk about the other side of it, which is ETFs. So what are ETFs? You're probably wondering. Well, it's simple. Instant diversification and market exposure at the click of a button. You don't have to worry about research because there's certain things that happen here. Now on the screen, the top S&P ones, right? The S&P is a top 500 US companies. And you can see on average, the growth has been pretty damn good. And yeah, there's many different ones and there's different versions of them and all kinds of good stuff done by different providers. It depends on you. The biggest life hack I can give you is go for the one with the most money in, because that is where the most popular is. And that's probably the easiest and most passive and broadest exposure anyways, because it's great for beginners. Most of the money's in them. And guess what? They manage them anyways. So for example, with this accumulation fund from BlackRock, it's got a decent amount of exposure in terms of fund size. It's got 503. And you don't get paid. You get accumulation. Basically, if any of these get dividends, which they will, you will get a percentage put back into it and your unit will grow and grow and grow, and that will also compound. So essentially what you're doing is you're getting a slice of the entire market at one button click. Pretty clever, really. But with the S&P 500, it's not managed massively because it is a top 500. Let me go a little bit deeper in terms of a niche where they may be managed a bit more. So for example, with this fund, this is the iShares S&P 500 Information Technology sector. There's only 68 here. Decent amount of money in it. There's a lot of, good stocks in here, but they may be moved around a bit more, for example, depending on performance. So that is one factor you got to look into. You are basically trusting them with managing it for you. And this is something else. This is a Morningstar Van Heck developed market dividend leaders. So what this is all the dividend leaders, so all the top dividend stocks out there, and they might well be changed and moved around in multiple different countries in different sectors. So there's a lot more to it. But the reality is they may well move and shop and change them quite a lot. But again, you have instant exposure. You have a 3.83% yield. And yeah, it will probably move pretty well and do okay. But reality is it depends on what you want. If you want a very, very simple fund, this is probably a good one. If you don't want to have the situation of individual stocks, which we will go into the pros and cons, which usually the con is for most dividend holders versus an ETF, you got to pick the stocks. So what the biggest situation, as I just alluded to, is you've got to choose a stock. So when you go into like the Trading 212 or Invest Engine, and if you're interested in like real beginner stuff, I would always recommend Invest Engine just for the simplicity. But the big thing with that is it's just ETFs. If you are a beginner and you are like, whoa, my brain's on fire, go down to the links below and go to Invest Engine. Because even though your capital is at risk, it is a lot easier to do it via the ETF world than it is to do it with the individual stocks, for example. So I would recommend that. It's much easier. And they have every fund anyway. So it's pretty good. But always do your research, of course. So as I say, going back to it, you're overawed by saying, oh my God, look at all these red and green numbers and all these different stocks and where do I get my research from and what should I buy and why should I buy it and all that kind of good stuff, right? So the thing is, with dividend stocks, you have control of them. Whereas with an ETF, the fund will decide what goes in and out, right? Obviously, with that, you have lower diversification with dividend stocks. And I'll showcase my whole portfolio in a second. I'll show you why the differences are when you buy each one. But with an ETF, you've got huge diversification because even if you are in like a very, very small niche, so say, for example, precious metals, you may have a load of different things in there. But with one stock, you've got one thing, one entity, huge. But as I say, you can go to a bigger fund. The All World Fund, which is what I go into, has 3,600 stocks. High diversification. Now, when we talk about that, you've got to talk about yield. ETFs have very low yield mostly unless you go for a specific dividend stock, which is fine, or a dividend ETF in a way. Now, the reality is, yes, with dividend growth and yield, depending on what you buy, this could increase. This could also decrease depending on the risk that you have in terms of the company that you're going for. Ideally, you don't want to go too crazy with the yield because that becomes a bit of an issue because you will get a poor stock performance. But as you can imagine, it's research, isn't it? What do you want to do? Bags of research, get all the information at a tip of a button. And yeah, you can go for it. And then you can diversify between, 10 to 15 different stocks. That's fine. But yeah, they're both very different, but they both have, I think, a very, very correct place in anyone's portfolio. In terms of it, in like summary, dividend investing will give you control and income growth. income growth is the key factor here. Whereas an ETF will give you that simplicity and diversification. It's about choosing between, as I said at the start of this video, time, risk, age, and again, your personality. Because what I have, and which is my personal mix, which we do need to talk about, I have a mixture of two. I have my dividend stocks, which I want to grow to a certain point by the age of 50, as you can see there, £1 million, which could be quite fun. And then I also have the all-world fund below. And what we're going to do here, we're going to invest in both of them to showcase how it works. So if you're in, say, trading 2-on-2, you can do it into a pie. I would always recommend, as a little bit of a life hack, turn off the reinvesting because it reinvests a whole pie versus the one. You want to reinvest the capital that you got from a company. So say, for example, the other day I got like 50 odd quid from Drax or whatever. I want to put that back directly into Drax, right? Because that's the best way of doing it. So with this, I've got £800 in cash in my broker here. So what I want to do here, I want to plonk 400 quid in, right? So with my pie already allocated, I've already allocated up to certain numbers based on performance and all kinds of stuff. So if something's done bad, it will buy more. If something's done well, it'll buy less. That's kind of the factor of it. That's a self-balancing way of doing it. You can do it by targets. So this is what I got in my pie, like 10%, 9%, 8%, whatever. These are like the overall metrics of the risk on each one, because it is a slice of my overall portfolio divided by how many stocks I've gotten in terms of different weight. But I prefer self-balancing because I am a big believer in buying the underweight stocks based on performance, because I want to get more units, and therefore as it recovers I will get more money. It's basically you're buying the dip. So once I press next here, it will just do all stamp duty and all that kind of good stuff, and it will invest for me. So that's doing it in terms of my dividend individual stocks. In terms of my all-world fund here, I took £500 of profit out and put it into Soluna. That is a very high-risk data mining thing around AI, which could do well, maybe not. Not financial advice, of course, but I'm just giving it a bit of a punt. I've already lost money on this, but I want to build some money back off it because I've rebought it. I do think they'll do well over the long term, so I'm just going to sit in it and see what happens. However, with ETFs, you are just buying it, and guess what happens? When you do this, it will just go in as and when. I've got £400 literally left over. I will get 3.14 unit shares, and it will just buy at that current price, and that's it. Order placed. It will go through in a jiffy, and then that's it. Simple as that. And that is how it all kind of somewhat works. It's nothing crazy. It's just the way it is. But when you use other brokers, it may well do it over the course of 3 or 4 days. Usually, there you go, it's gone through. You can't really see it because of my head, but it has just gone through. So it's pretty much instant. It's easy to do, and you can sell it at a drop of a sixpence if you want. You can buy more, you can buy different things. And again, if you go into the likes of any broker, if you go to their homepage, if you go to new on ETFs or equities or whatever there, or the equity ETFs, there's many different ones. Obviously do your research, but there's that many choices. It's unbelievable. And it does make it quite simple in that sense. But for me, the final takeaway, and the most obvious, is I would recommend to anyone do both. I think ETFs are easy, they're instantly diversification in terms of that sense. But the one thing I want to say is a bit of a psychological thing is the market's very hot right now, and there's a lot of people getting very giddy. And for me, the S&P and the NASDAQ and all these ETFs doing very well. Past performance does not give you the right for a future result. It doesn't, right? You've all heard that sort of term in different ways. Dividend stocks is income. So for me, what I would say is have an ETF that's strong and you're willing to hold for years, but also have an eye on dividend stocks to diversify profits into something a bit more stable, more solid, that will eventually pay you an income, because if you combine both of them, you will make more money. Now, in this video, I haven't really showed you the compound effect much, but if you look at the obvious, if your income is growing every single year and you're reinvesting that income, it will eventually compound. Likewise with, say, making an 8 or a 10 or a 12% return every single year on your profit or your units essentially that you bought in, say, the S&P. You need to do something with that profit, and you need to diversify, move it. It's like having a pension fund where they move it from cash into bonds or bonds back into stocks, depending on the market conditions. If you compound the growth of the profit, essentially, put it into something more stable, and that will then generate an income, and that will eventually compound, and then you will get to a point where you will get some silly numbers. Because with my own portfolio, in 10 years' time, if I keep putting 20 grand in, I know for a fact it will make me at least £10,000 to £12,000 in income on autopilot every single year. I reinvest that, it will grow, grow, grow. If you want some more ETFs, watch this video here, it'll help you a lot. And yeah, links below to all the tools that I've used in this video if you're interested. They're all very good, and you probably do need one of them at least.